Imagine you had a basket of your absolute favorite candy. Every single day, just for holding that basket, someone drops a little extra candy inside. You never have to do anything. You just hold it, and the candy keeps coming. Now imagine one day you open that basket and half the candy has changed. Some of your old favorites are gone. New ones you have never tried before are sitting there instead. You did not ask for it. Nobody warned you. It just happened. That is exactly what just happened to one of the most popular dividend investments in the entire market, SCHD. And today, we are going to break down every single piece of that change in the simplest way possible, so you know exactly what it means for your money. It is designed to pay you steadily, year after year, like clockwork. SCHD stands for the Schwab United States Dividend Equity ETF. Now that sounds complicated, but here is the simple version. SCHD is basically a basket of strong, well-established companies that pay you money just for owning a piece of them. That payment is called a dividend. So here is how it works in the simplest terms possible. You buy shares of SCHD. The companies inside SCHD pay dividends to their shareholders on a regular basis. Because you own SCHD, you collect a portion of those dividends automatically. The goal was not to chase excitement. The goal was stability. In March of 2026, SCHD went through what is called a reconstitution. That is just a fancy word for saying the basket got reshuffled. Some companies were removed, and new companies were added in their place. This happens periodically as part of how SCHD is designed to work. But this particular reconstitution was bigger than usual, and it caused a lot of conversation across the investing community. So what exactly changed? The biggest shift was in the energy sector. Oil and gas companies, which had previously made up a significant portion of SCHD, got cut back considerably. Energy exposure dropped by roughly 8%. That is not a small number. At the same time, healthcare companies and technology companies were added in larger amounts, increasing the overall weight of those sectors inside the fund. For most long-term dividend investors, that is actually a reasonable trade to make. Here is the honest answer. It matters because the companies paying your dividends have changed, and the risk profile of your investment has shifted. Before this reconstitution, SCHD had more exposure to energy, which meant your returns were partially tied to what was happening in the oil market. If energy boomed, SCHD benefited. If energy crashed, SCHD felt it. That kind of sector concentration can be exciting when things go well, but it can also be painful when they do not. With the new composition, SCHD is more spread out across different industries. Healthcare companies tend to perform steadily regardless of what the economy is doing because people always need medicine and medical care. Technology companies, while sometimes volatile on their own, add a layer of growth potential that SCHD did not have as much of before. The good news is that this makes SCHD more balanced and less dependent on any single sector performing well. It adjusts the foundation slightly, but the building is still standing. Is the income still there? The short answer is yes. Despite all the changes to which companies are inside the fund, the dividend yield has remained relatively consistent. SCHD is still sitting in the range of 3.3% to 3.6% yield, which means for every $1,000 you have invested, you are still collecting roughly $33 to $36 per year in dividend income. The companies changed, but the income stream did not disappear. You are still getting paid. You are just getting paid from a slightly different group of companies than you were before. The question you need to ask yourself is simple. Subscribe right now, because the next video is going to show you exactly how to build a $1,000 per month dividend portfolio, step by step, starting from zero. If you already own SCHD, here is the straightforward take. Nothing scary happened. You are now holding a more diversified version of the same fund you bought into. Your exposure to oil price swings has been reduced, and your exposure to healthcare and technology has increased. That means your portfolio is less likely to take a big hit if energy prices drop, and it has a bit more stability built in from sectors that tend to hold up well over time.